Welcome to Do You Ever Wonder? The show that brings you answers to many of the questions that you may have, but with no one to ask. Do You Ever Wonder is hosted by Mike Haltman, CEO of Hallmark Abstract Service, who, like you, has always been deeply curious about a wide variety of topics. Each week, Mike will be speaking with guests who are leaders in their field and who have inspirational stories to tell. So now, sit back and enjoy the show.
Hello, everyone, and indeed, we are ready for another episode of Do You Ever Wonder? My name is Mike Haltman. I am your host, and today we're touching on one part of the real estate market a little bit different than what we've done for the last couple of weeks. We had a commercial office building owner who had described different ways that he was trying to attract tenants. We had a small multifamily owner who had one unit in Staten Island who took us on the tour of how she was screwed over the last few years by city regulation, COVID, uh, rent and eviction moratoriums, all of that good stuff. But today we touch on a part of the real estate market that is important for everyone in terms of people looking to get financing, and that is the mortgage market. So today's guest is a senior vice president and a retail divisional leader at Cardinal Financial. He is also the owner or the founder of Home Qualified, which we're going to touch on a little bit later. But Ralph DiBignara, and I hope I pronounced that right.
You did
Welcome.
good. Thank you. Thank you for having me on.
Absolutely, absolutely. So I wasn't sure if Mary McPhail was going to be joining us, but it's great to just be with you. So you mentioned you had some challenges in 2008. Was that your biggest challenge?
Yeah, I would say so. I got in the business about 2001, and I kind of bought into the whole false narrative that it was going to get better every single year, and it did until 2008. So I was at the time I was running a mortgage division for Deutsche Bank, which is a publicly traded company. I was a senior vice president there, and I was probably responsible between 300 and 400 people, and everything seemed normal. I was walking up the block from the building was on Maiden Lane, right by Wall Street in downtown Manhattan. I was walking up the block from my apartment to my office, and I got a text message or an email at the time that said, "We're eliminating all these products." And I said, well, that can't be right, because that's 99.9% of the stuff I do every single day. And that was kind of the beginning of the end. Yeah, so I went from really, I had no history in making money or being around somebody who knew how to manage their finances. My family was very hardworking, but we kind of lived, my father worked full jobs. So he lived as he could put money away. So I was learning on the go, and I made some stupid decisions for sure. So when that crash happened, I kind of lost everything, and it was a complete start over for me in the business and life and investing and everything else.
You know what? 2008. So I had a commercial mortgage business that I owned that was no longer viable, and my wife was in a hard money residential construction lending business that was no longer viable, and we too had to go through some hard times, reinvent, and get back on the right track. And we did it through title, and you did it through the mortgage business, which
Yeah.
it was you have to look back and be proud of persevering through some really challenging and difficult times.
Yeah, for sure. I mean, it definitely it was what I needed. I mean, at the time, it didn't feel like that. It felt very dark as you kind of went through. But as I look back on it now, it really was like almost going to college again. It set me up for the rest of my career. It taught me some lessons that I couldn't have learned unless I experienced them, and it really set the foundation for what we've built today. But I had to learn the hard way.
You know what? It's there's an old saying: "What doesn't kill you makes you stronger." And here you are, man. You're strong.
Thank you.
So let me ask you this. I remember 2008 like it was yesterday. 2023, banks have stopped looking to lend. Interest rates have spiked, and in my opinion, aren't going to be coming down anytime soon. How would you compare? Obviously, back then, banks couldn't lend because they were going out of business. Today, they have an aversion to lending. How do you compare the atmosphere? So there haven't been the proverbial shit hasn't hit the fan yet.
Mhm.
In 2008, it hit, and it was. I mean, there were some inklings that there were issues going on, no question. But today we're rolling down the road. Everyone's happy or happy-ish. How would you compare the two scenarios?
Yeah, it's they're two very trying markets, but completely different. I think in 2008, at least on the residential side, mostly we were dealing with an oversupply and credit was too easy to obtain. Now we're dealing. The biggest problem we have, besides interest rates, and I don't think interest rates are really the biggest issue right now. The biggest issue right now is an undersupply, especially on the residential side, where we don't have enough homes for sale in the Northeast, specifically, worse than most places. So there's a barrier to access to real estate, which is creating bidding wars, which is creating overinflated values. So it's a completely different market, and I think I'd like to get your perspective on it too. But this is a different market than I've ever seen. I've never seen anything like this. So I think how you combat that, and we're probably 75 to 80% residential. So a lot of what I'm doing is residential on a daily basis. But I think how you combat that is you be as well-rounded as possible. Like when you said about 2008 that your wife was in hard money, and I remember when COVID first started, at the beginning of that, all the like residential commercial style loans disappeared, the hard money loans disappeared. That was like a wow. And then for the people who weren't well-rounded and weren't doing a bunch of different things, and they were just doing that, same thing happened again, right? You lost a whole entire pipeline, you had to start over. So I think the key in any market, if you're going to be in this business, is to be as diversified as possible. I think that's the best way to avoid a complete disaster. You're going to have a downturn, and I think there's no way to avoid that. But to avoid being wiped out, I think if you're diversified, you could withstand the bad markets and then get back, last until you get back to a market that's stable.
Right. No, I do not disagree with that. But now, Cardinal Financial, I know John LaPresti. I know some guys over at Cardinal. What do you guys do to differentiate yourself? So I'm in the title business.
Sure.
People think we're a commodity. We're not, but I'm sure the same people think that mortgages are a commodity. So
Yeah.
what do you do for the owner of a house?
Mhm.
Finances are difficult at best. How are you maneuvering around that? Is a HELOC? Do you do HELOCs? Is that an option?
Yeah, we do. So if there's a product out there, we have it. We service about 95% of the loans we have. Whatever Fannie, Freddie, and FHA does, there's no we do exactly what everybody else, the agencies allow us to do. On top of that, we have a decent amount of niche products, and home equities are one of them.
Okay.
So accessing equity is difficult now. If you have, I think that the number Fannie Mae put out recently was 80% of the market has less than a 6% interest rate, and I think it was like 40% has less than like a 4% interest rate. So how do you refinance? But the problem we're seeing is that consumer debt is at an all-time high. We've never had more debt out there at high interest rates. So I think what you're going to see with refinance is outside of home equity lines, which are getting more and more difficult to access, you're going to see people have to refinance for rates where they are today, because the average credit card debt is somewhere around 30%. You can't survive that way. So
God forbid you're late 1 month, it explodes even higher.
Sure. Yeah. So I think that what you're going to see is some activity in the market over the next 12 months of people either selling and or refinancing, not a huge amount, but people doing that because they have to clear up this debt. And what we have been gifted in this market is increased equity that we probably would have had if we didn't have COVID and we didn't have a shortage of inventory and all that stuff. So some of it we were given and some of it will be taken back because, the debt is really gotten out of control. And I think that's the biggest piano hanging over our head right now is consumer credit card debt, which is again at an all-time high, and that's a little bit scary to me.
So do you have, I don't want to use the word hook, but do you have at Cardinal for the home buyer, for the family looking to refinance or get a HELOC? Are there any hooks you offer that give you the differentiation that you might be looking for from the bank on their corner?
I think we have products that you can access, whether it's a second mortgage or a HELOC, that gives, that's an option, right? The other thing, we're making ease of transaction a little bit more if somebody needs to access that capital, because a lot of times when you're going to refinance, especially in this market, you don't even have to do an appraisal. There's appraisal waivers on a lot of properties based on your zip code and when you bought the property. So I think ease of transaction, whereas if you wanted to come to us and refinance your property today because you're like, I had enough, I got to get the cash, I need it for this, I need it for that, you probably could be in and out in the minimal amount of time, 10 to 14 days. So I think, ease of access, ease of transaction. And if there is a product in the market that allows cash out refinances, we possess it, but you have to be willing to take a higher interest rate. And I think that's the bullet that people are going to have to buy, because even home equity lines, they're really based around prime rate.
Of course.
Prime rate today is still higher than any of the rates you got in a 30-year fix 2 years ago. So
6%. No, it's, you know what? I think that slowly, and it's going to be slow because, since 2010, interest rates have been manipulated to be unbelievably low, and I think we're going to start to normalize. But yeah, no, I agree. I think it's a slow process where people come to rationalize, hey, it ain't getting a whole lot better, and if I want to do something, I should probably just do it.
definitely. And sometimes we're too prideful, stubborn. We like that low interest rate. And I have people telling me all the time, it's like, I got a 2.7%. That doesn't pay the bill at the end of the month. So, I think, financial health is important, and making sure you're in a stable. And the good thing about real estate, and I'm a product of this from 2005 and 2006, when I bought properties and they were worth 30 cents on the dollar in other states. The long-term holding of real estate will outrun your stupid mistakes, right? Like holding real estate is made up for all the dumb decisions I've made, as long as I was able to hold it. So I think that if you have to use that asset to pay off some debt, then as long as you're willing to hold the property, or you have some kind of plan or exit strategy, then, ultimately it's going to bail you out.
You know what? Those are, using the word bailout and,
Yeah. It's a scary word.
yeah. So let me ask you this, for the builders. I know in my neighborhood, builders are building homes, they're knocking down homes, they're building homes, they're asking $3 million. What are they, I know there's a way that they could potentially to try and lure buyers, because those are big numbers,
Yep.
especially at 7% mortgages versus 3% mortgages.
Sure.
So do you offer builders the ability to offer as a perk to their buyers, they can buy down, the builder can buy down the rate and offer that to their buyers?
So we offer a couple of things that help builders. So first of all, we actually have our own construction to permanent loan for buyers. So if a builder has a lot and they have specs on a property and they don't want to finance it themselves, they're actually able to come to us, because let's understand that as a buyer, if you could buy a property now that was going to be built in a year from now, you probably would still do it, as long as you get a reasonable price. So in that situation, we can help the builders finance it where they're not carrying all the burden. On top of that, there's more, even outside of the cost, where they can definitely use their own funds to help the buyer buy down the rate. But there's more down payment assistance programs now that I've ever seen. Some are state, some are local, some are federal. So we probably have 4 or 5 per state right now of down payment assistance programs. And you have to qualify for it income purposes, but you'd be shocked at how many people qualify at this point. We're doing loans, down payment assistance, that are $700,000, $800,000, $900,000 loans that people are using down payment assistance for. So what the government has done, because there is a barrier of entry, is they've made more of these programs available, and that definitely helps the builder, get somebody in there that can actually qualify without having to drain every single bit of their savings.
Right. So for someone who's going to be buying the home, who's going to be taking out a mortgage, what is getting a 10, 7, 5-year ARM? Is that their best bet these days?
Yeah, it's an option. But even so, I've always been taught, and I have an ARM on the house I live in, and I had a strategy for that. So I think it's an option as long as you understand the product. I think where we all got in trouble in the early 2000s was that everybody was going into ARMs. They didn't understand the product. They didn't understand the adjustments. For my purposes, I bought a house that took a 7-year ARM with a lower interest rate. And my thought process was, in the next 7 years, I'm either going to pay this house off or sell it. And I would rather take the lower interest payment, because the interest rates on ARMs are going to be lower for the next 7 to 10 years. And I know what my exit strategy is. I think as long as you have a plan that covers you once the loan adjusts, then yes, I think taking an ARM at this point is a great, you can still get rates in the 6s on ARMs, whereas other rates are in the 7s. So I think if getting into a property now, that would be what I'd move. And also, I would be open to taking an ARM now as well, because ultimately, at some point over the next 24 months, rates will drop. I don't think they're going to drop into the threes and the fours. I think they'll get back to the fives. I don't know when that's going to happen, but I think they'll get back to the fives again at some point
Well,
and
people
refinance.
right.
So, I would look at that as an option for sure, as getting into a house at a cheaper payment now where payments are very, very high and much more costly.
Okay, no, that's great. So I was talking to a friend of mine this morning who owns a real estate company in the city, and he was crying. And it's a rental company, and rental companies have been doing gangbusters. But he was crying because he said business is unbelievably slow. The sales market, I know, people who I speak to on a regular basis, slow. So how is Cardinal weathering this slow storm?
Yeah. What we've really had to do is get ahead of the curve. So two things. Cardinal is very, very based around our technology. We have proprietary technology called Octane. It's our loan operation system. It eliminates a lot of everyday kind of tasks that makes the cost to produce these loans a little cheaper for us. So that helps. And then the second thing, unfortunately, which is a casualty of this business, is that we've had to stay ahead on our expenses and cut back staff, which you're seeing throughout the industry. Whereas, we got to you got to be lean and mean. Because if you're not, you're not going to be able to survive. Because I think a lot of people got fat over the last few years, obviously, just to try to keep up with the volume that was coming in. So
Yep.
we really try to do is, with me and my partners, what we're trying to do is we're trying to think 3 or 4 months ahead always. So we're looking at our expenses for January and September. And as you know, you're in this market, right? December, January, February are notoriously slow months seasonally. So we're trying to get ahead of our expenses now. So when that happens, we're not laying people off or cutting people's salaries or doing that kind of stuff. So I think now more than ever, it's planning ahead. If you plan ahead, you can survive. But having a rosy outlook, the last 3 months, I would be willing to bet when the numbers come out will be the best 3 months for any mortgage company in the last 18 months.
Okay.
Because it was summer, it was seasonal, it was a little bit busier. That's not going to be the norm for the next 6 months. So I think that we have to prepare for that. And as long as we do that and we're realistic about it, we can, we can be stable and grow still.
I mean, I appreciate the term you use, which is lean and mean, because that's the way, my wife is my partner in this company, and that's the way that we run things. Because you know what, you can, when the money comes in, if if it's burning a hole in your pocket, you spend it, you expand, you grow your fixed costs. Ultimately nothing lasts forever. So the fact that you guys are lean and mean is the smart way to do business.
Yeah, I think it's the only way right now. And listen, it's unfortunate, but I think, if you aren't realistic about where we are, and the truth of the matter is that we can watch all the experts we want on TV and watch the market and all that stuff, but nobody knows where we're really headed right now, or what recession means in this type of market, right? So I just, not to be a negative, but just to be realistic, like this is what we have to be. And I think you are probably a great example of it, right? Because you're a business owner who understands you got to be. I say to myself all the time, it's like, oh, we need help for this, and this. We don't have the ability to have that help right now. We have to do more ourselves, right? I'm going to have to do more on a daily basis
Absolutely.
than I was doing before. So that's just what it is. And if you prepare for the market that way, I know this business is cyclical. You'll always survive and you'll always eventually thrive again, but you have to prepare in the downtimes.
You have to be able to withstand. So you had said another word a little bit ago, pray. And I was a bond trader in the '80s when I got out of business school, and hope and pray is not you buy a position. If it ain't working, a lot of times your first loss is your best loss. So it's no different than, if you think things are going in the wrong direction, you get rid of staff, you pare things down, and you have to have realism, not rose-colored glasses necessarily.
Yeah, and you're a good person to have these conversations with, right? Because I think you see mortgage companies who, when the times are good, they spend, right? They spend. And 2020 and 2021 were kind of a perfect storm because we were busy. You had less overhead because people were working from home. So it was kind of a perfect storm of the best market you could ever imagine being in, right? I think it was almost better than the early 2000s because of how we were running things but where we're going right now is I think over the next 6 months, I think you'll see the business change for good again. where there'll be consolidation, in my opinion, of companies. Again, there'll be less companies out there doing the business. Besides the bank model, you have the broker model in some aspects where it's lean and mean, right? So you'll have more of that pop up again. But the business I will be changed again, like it was changed in 2007, 2008, just in a different way.
Right. So, speaking of a business that's changing, a business that's cyclical, a business that has good times, it has bad times. If I'm coming out of school now, what would you recommend? Would I go into the mortgage business?
That's an interesting. So I actually read something yesterday that would tell me that I still think it's a good business to be in. There was a stat that came out that Redfin did a survey last month with Gen Z, which is the next generation of buyers, right? That 40% of them already are working to save for down payments. And 70, I think it was between 70 and 80% of them still view real estate as something they want to own. Now, whether they're going to live there or not is something different, but this is the next generation of home buyers. They'll be the next group after millennials that'll be the largest group of home buyers. And they're still viewing real estate in this country as an asset they want to own. So that tells me that this will be a business that's going to flourish through the next generation, right? And on top of that, we as human beings are living more, right? Millennials, baby boomers, we're all living more. They were going to own real estate. I think a couple of things tell me that this is still a good business to be in. So this is a good time to get in. Yeah,
You know what? So we opened the title company in 2008. Not what someone looking in from the outside would say, wow, that's a really good time to get involved in title and in the real estate business. But, as a former trader, one of the tenets is you want to get into good positions when no one else wants them. So, if you as a mortgage company are lean and mean now, lean and meaner, that provides opportunities for people who want to get into the industry or want to move companies, or it's out of every crisis comes opportunity.
Yeah, and I think this, if you listen to any expert, you're always running when everybody else is running out. Like this would be a harder time to learn, but I think a better time.
So, for the people who remain at Cardinal, what do you and the rest of the leadership there, how do you motivate? How do you pump your guys up? What do you tell them when it's time to get on the phone, or however it is that they generate business? How do you keep them motivated when obviously it ain't easy?
I'm sorry, I was getting a little feedback.
I hope that wasn't your best stuff that got
no, I think you got to be motivated in a way that you got to get up and if you do that, you'll eventually. I know this business, whereas after the leanest times, the times after that were the best times. So if you build a solid foundation during the times where it's hard, when you get out of this, you'll be supercharged. And that's how we try to keep it motivated, right? Keep building that foundation. If you're doing solid, consistent business now, that when this ends, and it's going to end, I guarantee it. When this ends, you will be in such a position to make more money than you've ever made before, as long as you're willing to get through the tougher times like now.
It's tough. You have to, you always have to make certain sacrifices. And if making money is one of them, that's a hard one to sacrifice. But, agreed. If you want to stay in the business, you have to get through the lean times. You got to put your game face on. You got to keep fighting the good fight every day. And I have no doubt that's what you're doing. So tell me a little bit about Home Qualified.
Yeah, so Home Qualified, I built out, I think in around 2016, 2017, I founded it. And it's a real estate news website. It was meant to help really more first-time home buyers and first-time investors. So it's still something we work on every single day. We drive news in through there. We put out videos on tips to buy, on how you buy. It's really supposed to be an insider's view to what you need to know as a consumer to buy, sell, and invest in this market. So it's a news website. We're actually launching the Home Qualified News Network in 2 weeks, where it's going to be a weekly show that goes through what's going on. I think people need market updates weekly at this point. What's going on today, how you can take advantage of it, where you should be looking, just to try to give guidance. But it's a free informational website that we have out there that just tries to draw more people into us to try to do business with.
You know what? So I went to the website. I went through different aspects of the website, and it's very smart. It's no different than what I try and do with my podcast. I love podcasting. I love
Yeah,
speaking to different people. I love trying to get different kinds of guests on. But at the same time, it's a way that I provide a footprint to people who I would ultimately like to do business with. It's I'm not going to say it's a marketing tool, but on some level, it's a way for me to grow my brand. And your website for Home Qualified is great because it's a way for you to grow your brand. It's a way for you to entice potential borrowers. It offers them the opportunity to go on and really explore mortgage opportunities. So I think it's great. Brilliant, brilliant.
thank you. I appreciate that. Yeah, listen, I think educating people in this market is the best way to help and necessarily grow brand and draw people into you. And that's the biggest thing. I'd like to connect with people. I think that where we can help each other, and I think that's the best way to kind of grow business and through value that way.
No, I think that's great. You know what? You do have to give back. I'm in various networking groups where giving is a key part of the process, and it's true. So, I think the more you can give to people, I think it comes back to you. It's a I forget the word, but it's a cycle. You give, and hopefully you don't do it on a quid pro quo basis, but you hope that at some point by giving you see something in return.
I agree. Yeah, absolutely. I feel like if you always put your foot forward that way, you'll get something back eventually.
Let's hope so. So Ralph, if somebody wanted to reach you, how would they do it?
My website is my name. It's ralphdbagnaran.com. You can always reach me there. My Home Qualified website, there's a contact there. Homequalified.com is a great place to meet me. And my Instagram, I'm pretty active on. I put up a lot of videos as far as tips, buying, and stuff like that. And that's DIBUG. It's Instagram.com, DIBUG. And I answer all my messages there. Maybe not immediately, but I always answer them.
Okay. And if anyone has a question, did you give out your email?
I did. I will. It's Ralph at homequalified with a D.com.
Terrific. You know what, Ralph? We will come back to this in a year's time, and we will gauge just exactly where we've gone. Hopefully, we are plateauing, and hopefully, when we come back a year from now, we will be gangbusters.
I hope so too. From your mouth to God's ears.
And I have no doubt that you will succeed at what you're doing because obviously you have ambition and you're also creating. You have ideas.
Thank you. I appreciate that.
You can't sit
Thank you for
still.
doing this. I think this is great. I think podcasting is great, especially to get information that you really, really need. If I would have had stuff like this back in 2008, it would have been a lot shorter pain period for me.
I'm not sure about if I had it, but we'll see. Again, man, a real pleasure.
Thank you.
Thank you for listening to Do You Ever Wonder? And we hope that you enjoyed the show. Next week, we will have another terrific guest telling their story. And if there are any specific topics you'd like to hear more about, please don't hesitate to let us know. Our curiosity, like yours, knows no bounds. Please subscribe and like and share this episode on your social media. See you next week.